Welcome back to the class, students, and welcome to the third part of Business Services series. This video covers insurance and postal services. So, let us see what you are going to learn in this video. After studying this topic, you will be able to understand meaning of insurance and its types, explain various principles of insurance, differentiate between different types of insurances, define postal services and its types. So let's see what is insurance. Insurance is basically a contract in writing between insured and insured. Insurer is the company which is giving insurance policy, which is going to compensate the insured, whereas insured is the person who has taken the insurance policy. So here the insurance company, that is insurer, agrees to indemnify the loss. Indemnify means to compensate the loss suffered by the insured due to the causes mentioned in the insurance contract. And in the return to this service, the insurance company will charge a regular payment called insurance premium, and this premium is to be paid regularly. It may be monthly, quarterly, half yearly, or annually, depending upon the terms and condition of the insurance contract. Now let us see various terms used in the insurance. The first term we are going to discuss is contract. Contract is the written agreement between the insured and the insurer. Insurer is the company who has agreed to compensate the loss of insured. That is basically insurance company. Insured is the person who has taken the insurance policy. Premium is the regular payment which the insured has agreed to pay to the insurance company. Indemnity means to calculate the loss in monetary terms. Subject matter is the property or the life for which the insurance has been taken. Policy contains the terms and conditions of the insurance contract. Now let's see what are the principles of insurance. The first principle we are going to take up is utmost good faith. So according to this principle, at the time of entering into an insurance contract, the insured must reveal all the material information to the insured. Now, material information means the information which may enhance the risk. So that such kind of information should be revealed at the time of entering into a contract. Normally, people try to conceal these kind of information because it may affect the amount of premium. So if the risk is higher, naturally the premium will be charged more by the insurance company. But if such information has been concealed and later on it comes into the surface, the insurance contract may be considered void or even cancelled. For example, while applying for life insurance, the insurance companies ask for the health status and family health history. So if somebody has concealed any material information about the health or family health history, then in future this contract may be cancelled, may become illegal, void, null. For example, someone has not revealed the fact that the person who is taking life insurance policy, that he has a habit of smoking. Because if he reveals that information, the premium may increase. But later on, if this information is revealed, is come into the knowledge of the insurance company, then it may seriously affect the insurance contract. So, at the time of entering into contract, the material facts should be clearly stated, should not be concealed. They should be clearly disclosed. And as far as insurance company is concerned, it should also disclose all the material facts related to the insurance policy. Principle is principle of insurable interest. Insurable interest means that if there is some loss to the subject matter of the insurance, then the insured must suffer physical, mental, or monetary loss. Only then we say that that insured has a insurable interest in that property or the subject matter of the insurance. So for taking insurance policy, one should have insurable interest in the subject matter. So for example, one cannot have insurable interest in the neighbor's home. So the insurance policy for neighbor's home, fire insurance policy for neighbor's home cannot be taken. One can take insurance policy for his own home, for his own wife, for his own children, not for the neighbor's children. So that's why insurable interest must be present at the time of taking the insurance policy. The next principle is indemnity. Indemnity means to compensate the actual loss suffered. So according to this principle, the insured will get compensation for the actual loss suffered by him or her. So if there is some loss happens, there is some accident, or in that case the insured will get only the actual amount of loss suffered, not the entire amount of the policy. For example, if somebody has taken a policy of rupees 10 lakh as fire insurance policy for rupees 10 lakh on his home, and his home accidentally got fire and there was a loss of rupees estimated by the insurance policy insurance company, it was rupees 5 lakh. Now the insurance company will compensate the insured for rupees 5 lakh only, not the entire amount of the policy will be compensated, that is rupees 10 lakh. So the insured will get the actual amount of loss suffered by him or her. This is because insurance is not a contract of making profit. So insured cannot make profit out of the insurance. So he will just only get the actual loss suffered by him, because it is a contract of making the loss good. So after indemnifying, after compensating, the insured must be at the same position at which he or she was before happening of loss. The next principle is causa proxima or proximate cause. So according to this principle, only those losses will be compensated which are because of the reasons mentioned in the insurance policy. So if the reason of the loss is not mentioned in the insurance policy, such losses are not compensated. For example, cargo was insured for marine insurance policy was taken for that, and while loading the cargo, mice entered the deck of the ship, and during the long journey the mice spoiled a whole cargo of the ship. So the company claimed compensation for the cargo from the insurance company, but the insurance company refused to pay compensation. Why? Because the proximate cause of the loss was not the sea perils, because marine insurance gave compensation against the losses suffered by the sea perils, but here the actual cause was mice, which is not sea perils. So the company, on the basis of principle of proximate cause, did not accept the claim. So if there are more than one causes of the loss, then the most direct and nearest cause will be taken as the proximate cause. Subrogation. According to this principle, after the insurance company has paid the compensation to the insured, then after that the residual property, which is the scrap which is left from the property, it belongs to the insurance company. So in other words, after payment of compensation, the insurance company shifts it into the place of the insured. So now it becomes the owner of the damaged property. So anything which could be sold will be sold by the insurance company. Again, this is because insurance is not a contract of making profit. So the insured cannot make profit by getting compensation as well as by selling the scrap. So now scrap will be sold by it belongs to the insurance company, and it will dispose of that scrap. Next principle is principle of contribution. So this principle is applicable when there are more than one insurance policy for the same subject matter. So when subject matter is insured with different insurers, then in case of happening of loss, the compensation will be contributed by all the insurance companies. So the amount of contribution by each company will be decided by the amount of sum assured. In the ratio of sum assured, the whole compensation will be divided among all the insurance companies. So it again, it is not the contract of profit making. It doesn't mean that if insured has suffered a loss, then he will or she will get compensation from all the insurance companies, and actual loss is rupees 1 lakh, and he has taken 3 insurance policies for the same subject matter, then the 3 companies will pay him 1 plus 1 plus 1 equal to 3 lakh rupees. Then actual loss is 1 lakh and he is going to get compensation of 3 lakh rupees, then he is going to make a profit of rupees 2 lakh, which is not allowed, which is not possible. So here, that's why if there is compensation is to be paid by more than one insurance companies, then they will contribute it on the basis of the sum assured. So in no case the insured will get compensation more than the actual loss suffered by him or her. Let us see what are the different types of insurances. That insurance is broadly divided into two types: life insurance and general insurance. General insurance is of many types. We are taking up three types here in your syllabus: marine insurance, fire insurance, and other insurance. So let's see what is life insurance. Life insurance is a contract whereby the insurance company undertakes to uh, give compensation to the loss suffered by the the loss of life of a person at the time of death or maturity of the policy, whichever comes early. So this is a contract whereby the insured will get the amount of the policy. The returns are assured, because if the person dies, the family members will get the amount of policy, where if the person doesn't die, then he or she himself herself will get the amount of policy. So this is a contract of assurance. There is an assured return in this kind of insurance policy. A person can take a life insurance policy of on his own life, or on the life of his own family members on which he or she has an insurable interest. The person who insures his life is called the assured. So the person can take a policy and become assured of returns, and this is a contract of assurance because here the returns are fixed. They are to be the compensation is to be given in any case, in case of death, or if the death doesn't happen, then in case of maturity of the policy. The principle of indemnity and principle of contribution are not applicable in this type of insurance. Why? Because the loss of life cannot be measured in monetary terms, so principle of indemnity cannot be applied to life insurance. Similarly, because the loss cannot be measured, so principle of contribution also does not apply to this type of insurance, because contribution could be made only when we know the actual loss. So here, if the person has taken more than one insurance policy on his or her own life or anyone else's life, then in case of death of that person, the compensation will be received from all the insurance companies. Earlier, there was a monopoly of LIC, Life Insurance Corporation of India, in Indian markets, but now many private companies have come forward and with a very different types of very versatile plans of life insurance, like Bajaj Alliance is there, Max Life, HDFC Life, Birla Sun Life is also there. All of these are the private insurance companies which also provide various types of insurance policies to the people of India. Next type of insurance is fire insurance. So the fire insurance is a contract whereby the insurance company undertakes to compensate the loss suffered due to the fire. So here the insurance policy is taken against property. The subject matter is a property in which the insured has an insurable interest. The claim of for compensation should satisfy the following condition in case of fire insurance: that there must be an actual loss due to fire, and the fire should be accidental. It should not be intentional. It should not be planned to take the benefit of insurance. So it should be accidental fire. Next is marine insurance. Marine insurance is a contract whereby the insurer agrees to indemnify the owner of a ship or cargo against risks which are incidental to marine adventure in consideration of premium. It covers a variety of risks like sinking or burning of ships, spoilage of the cargo, freight loss, etc. So there are different types of marine insurance. There is insurance of ship or hull. In this insurance, the insurance subject matter is the whole ship. Cargo insurance, here the subject matter is the cargo which is being transported in the ship. Freight insurance, here the subject matter of insurance is the risk of loss of freight by the shipping company if there is any destruction to the goods or there is any loss to the ship. Now, after this marine insurance and other insurance, we will take up health insurance. Health insurance is a contract whereby the insurance company undertakes to reimburse the expenses due to hospitalization of the insured on because of the illness in the insurance given in the insurance policy. In return, the companies charge the premium as usual. Now let's see what is the difference between life, fire, and marine insurance. So the first difference is on the basis of risk. So in case of life insurance, the risk is certain because either maturity or death is certain. It is going to take place. Whereas in case of fire insurance, risk is uncertain. There may or may not be a fire, loss by fire. In case of marine insurance also, the risk is uncertain because there may or may not be, this is a matter of chance, there may be an accident or there may not be any accident. The next difference is on the basis of period. The life insurance policy is for a long term. The period of the contract is very long term. It is 10, 15, 20 years, even 25, 30 years could be there. Whereas fire insurance policies are taken for short term, that is generally 1 year. Similarly, marine insurance policies are also for 1 year. Insurable interest. So, in case of life insurance, the insurable interest must be present at the time of taking the policy, but not necessary at the time of death. So, while the policy was taken up at that time, if there is insurable interest in the subject matter of the policy, then the policy can be taken. And at the time of happening of loss, if there is no insurable interest at that time, then there is no problem. Fire insurance, in case of fire insurance, insurable interest must be present at the time of taking the policy and at the time of happening of loss. In case of marine insurance, the insurable interest must be present only in the event of loss. Premium. In case of life insurance, premium paid is returned with or without bonus at the time of maturity or death of the insured. Whereas in case of fire insurance, the premium paid is not returned. If there is no loss, the premium is not returned back. In case of marine insurance also, the premium paid is not returned back. Payment of premium. In case of life insurance, the payment of premium is monthly, either or quarterly, half yearly, or yearly installments could be there. Whereas in case of fire insurance, there is the premium is paid only at the time of taking the policy. And similarly, in case of marine insurance, also the premium is paid one time at the time of taking the policy. Indemnity. The principle of indemnity is not applicable to life insurance because the loss of life cannot be measured in monetary terms, whereas in case of fire insurance, loss can be measured in monetary terms, so principle of indemnity is applicable here. Similarly, in case of marine insurance also, the loss can be measured, so principle of indemnity is applicable. Element. In life insurance, it has the element of both investment and protection. Protection in case of death before the maturity, whereas investment, if the person doesn't die, then he or she is going to get back the money he has paid to the insurance company with bonus or without bonus. So there is an element of investment as well. In case of fire insurance, there is only an element of protection. It means that if there is no loss, the money will not be returned back. Similarly, in case of marine insurance also, there is only an element of protection, not investment. As far as surrender value is concerned, life insurance policy has a surrender value because it is a long-term contract. So if the policy is to be surrendered before the date of maturity, its value could be calculated. Whereas in case of fire insurance, it is it is up to 1 year only, so there is no surrender value. Similarly, marine insurance also doesn't have any surrender value. Policy amount. In case of life insurance, the policy amount can be taken off any amount because the life is invaluable, so the amount will depend upon the that how much premium the insured can afford to pay. Whereas in case of fire insurance, the policy amount cannot be more than the value of property. Similarly, in case of marine insurance also, the policy value cannot be more than the value of the property which has been insured, like the value of cargo, ship, or freight. The next service we are going to take up is postal service. Postal service provided by the Government of India, and it provides national level as well as international level postal services. To provide postal services, the India has been divided into 22 postal circles. It is the most reliable service postal service available in the country, as well as speed post facility is also available under it, which helps to transfer the articles and documents from one place to another place at a very high speed. Let's see what are the different types of facilities available under postal services. The first we are going to take up is mail facilities. Mail facility include parcel service, registered parcel, registered mail, as well as insured parcels and insured mail services. Next one is speed post. Speed post is a high speed postal service provided by postal department, and it has over 1,000 destinations in India and well connected to 97 major countries across the globe. So one can send speed post parcel as well as letters outside the country as well. Registered post. Registered post is an ordinary post with special feature. It is more safe, secure, and record proof. The price of the register services, register post, is higher than the normal and speed post. Special records are kept to track the letters and the parcel which has been sent by registered post, and it takes usually 2 to 7 days to deliver the mail. Parcel service is available for sending articles from one place to another place. Courier. Courier is a person or a company that takes messages, letters, or parcels from one place to another place, or one person to another person. It is very much similar to postal services, but the difference is only that the postal services are provided by the government of India, whereas courier services are provided by the private service providers. So that's all for today's lesson. So till now, what we have done, let's see. We have done meaning and principles of insurance, types of insurance, life, fire, and marine, difference between life, fire, and marine insurance, and different types of postal services.